G'day, Beck. Thanks for the question. This is a phenomenal question. So I want to provide you with a little bit of insight, a couple of things to consider, because there are a couple of misconceptions around family trusts in particular and land tax. So let's cover this off. Now, this is general advice. This doesn't take into account your personal situation. I definitely advocate getting some financial and tax advice specific to your situation, because there are some pretty significant implications if you do get this wrong. So let's talk about a couple of things. Now, you're talking about land tax. So for those of you who don't know, every state besides Canberra has a land tax threshold, essentially meaning that you can accumulate property up to a certain level based on the land value and not pay any tax. Once you pass that threshold, then you will start paying land tax. It can add up pretty quickly, and it can be a pretty costly exercise. So it's something that you definitely need to take into account. Now, the thing to be mindful of is that a family trust has zero land tax threshold, meaning that every property that you have inside a family trust will be subject to land tax. So for many individuals, they consider whether it's best for them to hold a number of properties in their own personal name before they start using a family trust. And given that you're at that threshold, the reality is doing one over the other is not going to avoid the land tax, but it's then going to be the other considerations of does it provide you with a net benefit as a result of buying it in a family trust compared to something else. So what are those potential net benefits? Well, the first one is flexibility around tax treatment of the income and future capital gains. So if you as an individual are at top marginal tax rate or close to it, do you have other individuals that you could distribute both income and capital to in the future? So have you got a spouse that has a lower income? Have you got children that are adults? Because minor children, we can only give them a small amount of money. Are there other family members that we could distribute to, keeping in mind that when we distribute to these individuals, they can't give us the money back. So for most people, it's their immediate family or family that they are looking to build wealth with. The added benefit of that is that inside our family trust, you've still got access to the CGT discounts like you do as an individual. Whereas, say, for example, if you bought through a company, you would pay 30% tax as opposed to kind of a little bit less than 25%. So the next consideration is borrowing. The big thing for a lot of my clients when it comes to building substantial property portfolios is that their portfolio will grow at the capacity of their borrowing limit. We call it their debt ceiling. So in other words, it's the amount of money that the banks believe that you can service based on your income versus your expenses. And keeping in mind that your debt ceiling is diminishing because the banks put on a buffer rate, typically about 2 or 3% above the actual interest rate to basically future-proof against additional interest rate increases. And they only take about 80% of your investment income, depending on the bank that we're looking at. So what that basically means is for many people, they get stopped out at 2, 3 properties if they're lucky. This is why the vast majority of property investors in Australia only have 2 properties, and beyond that becomes very, very challenging. So this gives us an opportunity to use what we call a special purpose vehicle. So we can use a trust, we can use a company, sometimes we use a combination. And the benefit of this is that if we buy in that particular entity, there are some banks out there that, assuming that we can get that property to be cash flow neutral or positive, that we can have the banks exclude the debt, but they'll also exclude the income from that particular entity, allowing us to get additional borrowings later on down the track. This is where we really need to be strategic. And this is the reason why for many of my clients, we consider the tax implications, whether that be income tax, whether that be capital gains tax, whether that be land tax. We've got to realize property is the most highly taxed thing in this country, right? It's expensive to hold property. But we want to be strategic around considering these tax consequences, but also considering that in light of our ability to build a substantial property portfolio. Because once you get past 2 properties, you have to be more creative and more sophisticated in how you structure those properties. And if you don't, you won't be able to borrow again. So this is why you need to get advice, right? You really need 3 good people in your camp when you're looking to build a property portfolio. You need a great financial advisor who is to help you understand what you're actually trying to achieve and reverse engineer that into a roadmap. Property isn't the be-all and end-all. There's plenty of other ways for us to build wealth in this world. We ideally want to build a diversified portfolio. But you need a good financial advisor that's going to help you crunch the numbers and help you understand that in the context of your situation. 2, you need a great tax advisor or accountant, somebody who's not a historian, who's not looking in the past, who's going to help you look forwards and plan for the optimal tax outcome. Because we don't want to pay any bonuses to the tax man if we can avoid it. And 3, you need a great mortgage broker. You need a mortgage broker who understands building complex, sophisticated property portfolios who can help you use the bank's rules and various special purpose vehicles in order to maximize your borrowing capacity for the future. Good news is we do all of those things. So if you want some help with that, feel free to flick me a message or jump in the link in my bio, and happy to assist. Any questions? Let me know.